Hello everybody, Veta VA community. It is Helmer coming to you this week with your mortgage market update for the week. And I am joined this week with our guest, Thomas Sloan. Thomas, thanks for joining us. Please tell everybody a little bit about yourself.
Thanks for having me, Helmer. There's not much to tell. I've got 4 kids. I'm a loan originator in this crazy market. Been involved since 2018, jumped in 2020 full time and haven't looked back. It's been crazy.
Awesome. What part of the country are you from?
East Coast, Jersey, but not a typical Jersey guy.
Where in New Jersey? I was there for 30 years.
Right where Route 80 and 287 are. So Parsippany, Morristown, Newark is not too far. Yep.
My
Okay, yeah. Hiawatha is part of Parsippany. It's like 52 square mile town. It's huge.
Exactly. So, all right, everybody. Today, thank you for joining. Go ahead and ask any questions. If you're here, let us know that you say hello. And we would love to hear from you. If you I know many of you can't necessarily be here live, but we do get a lot of people that come back and watch us each week. Please go ahead, give us hashtag replay in the comments. Let us know that you were here. Remember, if you do have any questions, put them in the comments. Let me know if you're a consumer or a Veta VA pro. We do encourage questions from both of you. And with that said, let's go ahead and jump right in and go to the screens. We'll talk about what's going on in this crazy week, because it is a crazy week. So remember, as we jump in and talk about rates, this is not an offer to lend. And when we do talk rates, we're talking about averages and generalities. You definitely want to know for your unique situation what you have available, and you should always shop your rate. So keep that in mind. But all right, last week, where were we and what did we say? Well, I said, hey, rates were looking for a reason to improve a bit, but that we were walking on eggshells. And that was kind of my feeling. We had some data coming up on Friday. And that Friday data was jobs data. So it gave us how many new jobs were created, what was unemployment looking like, and how are wages doing. And I said, if that data came in showing that the labor market was starting to slow down or maybe get a little bit weaker, that we could see rates improve slightly. And you could see here I have slightly capitalized because it only should have been a little bit. And then I said, if Friday's jobs data comes in showing labor market strength, rates could move higher, maybe 1/8 to 1/4%. Now, that's what I said. What really happened? Well, what actually happened is that went all out the window. Thomas, are you familiar with why everything went all out the window last week?
Little bit.
I'll fill everybody in that's watching. So for all of you that are watching, what happened last week, why everything we thought was going to be changed is because you may have heard of a little lender called Silicon Valley Bank. Silicon Valley Bank was said to have failed, and it initiated and started what they, and I'm going to use quotes here, use my air quotes, what they call a banking crisis. So it was the first, or maybe I think it might have been the most publicized, but it was the first or second bank to quote unquote fail last week. And we had Signature Bank, and then there was one other one, and I can't remember the name off the top of my head. But anyway, what we've started to see happen is we've started to see cracks in the banking foundation due really to the Fed raising rates. And there's a lot of talk about this. And I don't want to, we could spend a half an hour talking about, why did banks end up in this situation and why did banks fail? But what I really want to do is focus on the effect that had on you as, somebody looking at mortgage rates. And the effect was rates went down a lot more than anybody would have expected. We call this a black swan event. It's when something totally unexpected comes in and actually changes the entire outlook. And the, VA rates, they fell into the low 6s. The week before, they had been in the mid to high 6s, and conventional rates that had been in the 7s fell to the mid and high 6s. And what we're seeing now is we're seeing a lot of volatility, right? So rates are bouncing around right now. And I want to give y'all some insight into what's going on and how that works. But Thomas, do you have any questions that I can answer about why maybe the things that happened with last week, why the banking had an effect, or how that affects the expected Fed rates? Do you have any questions on that?
Yeah, the technicals are quite complicated, but I guess I'd like to hear your kind of stance on exactly what it is that these banks are doing that are causing them to fail this badly, and how that affects the market so directly.
Okay, so I probably could have had one of my drawing slides up would make this clear for everybody, but I'll walk everybody through this. So what happens when a bank operates, a bank is there to make money. So how does a bank make money? Well, let's say that I'm a bank, and so I'm the Bank of Hammer, and Thomas and all of his friends, they're going to put their money, their checking accounts, their saving accounts into the Bank of Hammer. And for giving me that money, I'm going to give them a little bit of money back. So let's say that Thomas and his friends, you guys are well off. You put $10 million into the Bank of Hammer, and I'm going to give you 2% on your money. You're going to get a 2% return on your money in this market, and you're real happy about that. And that's how, things go. Well, as the Bank of Hammer, I've now got $10 million, but I have to pay out 2%. Well, if I'm going to pay out money, how do I come up with that money? Make money. So in order to make money, generally I can do that a couple of different ways. One way, I can lend money. I can lend money out for mortgages. I can lend money out for business loans. I can lend money out to do a lot of different things. And let's say I lend money out at 6%. So if I'm making a 6% return on the money, I have made enough profit that I can pay you 2%, you and your friends, and there's some money left over for me. All right. So the second way that I can make money, if I don't lend out money, and this is more of what a bank like Silicon Valley Bank did, is I can buy safe investments. I can buy treasuries and mortgage-backed securities and bonds, and they're going to give me a rate of return. And I can then, again, maybe it's a little bit lower, maybe it's only 4%, but I now make 4% and I can afford to pay you 2% and I'm still making money in the middle. Now, what happens, our government says, okay, that's great, but you also have to keep a reserve. There's a certain amount of money that you need to hold on to in case people want their money and, need to take some money out of the bank. Well, part of what's caused this current situation is that the large banks, Wells Fargo, Bank of America, the quote unquote too big to fail banks, anyone over, I think it's a threshold of 250 billion. But there's a threshold that larger banks, they have to have a certain amount of money on hand, a certain amount of liquid money on hand. And that's where the whole Fed funds rate and borrowing money in the reserves, it's actually all based on that. But the smaller banks, like Silicon Valley Bank, were allowed to slide. All right. They have a little bit of a different set of rules because the stress testing, as it was called and implemented in 2008 after our great meltdown, that was very strenuous on these smaller banks. So they didn't need that. So a bank like Silicon Valley Bank, they had money set aside in case, let's say Thomas wants to take his money back out. Okay, I've got money set aside. But what happens is, what if Thomas wants his money and if 3, 4, 5, 10 of Thomas's friends want their money? Well, I may only have $1 million because the other 9 million I've got lent out or I'm invested, right? So I have to come up with money now. That's called a run on the bank. If Thomas and all his friends, for whatever reason, want to pull their money out at the same time, and I don't have enough money stockpiled, that's a run on the bank, and that causes problems. Now, the reason that was a problem for the Silicon Valley Bank is that they had assets set aside. Well, when they need to go ahead and pay you, well, I need to sell these assets. The problem is they bought these assets in 2021 when they were growing very quickly and they had all this extra money coming in and they had to do something with it. And they bought mortgage bonds and treasuries at a very low rate at the time. And what happens is now, if let's say that they bought $100 worth, and again, this is oversimplification, but just make it easy for everyone to understand. If they bought $100 worth, well, they could sell that and then they get their $100 and they could pay Thomas off. The problem is that $100 worth that was in 2021 is only worth about $70 today because, in part, because of how the Fed has raised rates and it's devalued these other lower rate of return investments. So if they could hold on to them until maturity, which is 20 years, 30 years from now, not a problem because they're going to get all their money back, $100 on $100. But if they have to dump them now and get rid of them, they can't sell them for the $100 because it's not worth that in the open market. Someone says, I'll give you 70 for the 100. And that's what happened. So they were in a situation that they were taking huge losses to come up with the capital, with the money to go ahead and pay off their depositors. And the depositors were getting nervous and spreading the word, and all of social media and all the media were saying, hey, you need to get your money out of this. And that's what caused it. So there was a bit of a run on the bank. and and they had to get rid of that. So this is, there's so many different things going on right now. Regulators blaming the bank blaming the regulators, people blaming the Republicans in 2018, people blaming the Fed now for raising rates so aggressively. And you guys can read all about that in other media sources. But what that does for us today, let me show you guys the chart real quick. And Thomas, this one is a big one. So this is the expectation of what the Fed will do. And if y'all remember, over the last few months, I've been talking that mortgage rates move up and down with the expectation of what the Fed is going to do with the Fed rate through the rest of the year. And what this chart right here is, Thomas, is that we were expecting the Fed at the March meeting next week to raise their interest rate. Last week, it was expected that they were going to raise it by 0.5 point, and that in May, they were going to raise it again. And in June, they were going to raise it again. And that by the time we get to July, markets were expecting that the Fed rate was going to be at 5.5, maybe 5.75, and that possibly if the Fed needed to be aggressive in fighting inflation, that it could be even 6%. Well, now, because of these cracks in the system caused, in part because of the Fed raising rates, markets say, whoa, hold on. The Fed can't raise rates anymore. They can't. They just can't. And there's large companies with, economists that are saying the Fed is in a quandary because even though we have inflation, they can't raise these rates anymore because it's going to cause more instability in the banking market. And then like today, we get another article like Credit Suisse ignites a global market rout as banking fears return. These kinds of headlines are causing the markets to believe that the Fed right now, there's almost a 60% chance that the Fed will not raise rates at next week's meeting. Whereas just last week, we thought the Fed was going to raise rates by 0.5%. And that's a big swing. And it's all of what's going on here. If we look in July, we were expecting the Fed rate to be at 5.5 or maybe 5.75. Now, there's a lot of people that are saying the Fed is going to have to cut the interest rate. Right now, the Fed rate is at 4.5. Right now, markets are pricing in that the Fed is going to have to bring that rate down instead of up. So instead of going up to 5.75, they're looking at, nope, maybe 4%, maybe 3.75. Now, it's the expectation, and that's what's controlling mortgage rates right now. And indirectly, and again, I'm oversimplifying for y'all out there, but I could show you the fancy charts, mortgage-backed securities. This is the basis on where mortgage rates come from. And this is why we're seeing such a big move. If you follow the 10-year Treasury, and in the past sessions, I've talked about how this 10-year Treasury, if it went above 4%, mortgage rates were going to go up very high. Well, it is so far, it's at 3.41. That is, 60 basis points or 0.6% lower than 4%. We have seen a huge drop. And you can see the directions of these candlesticks, these lines that go down, 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 down. As this yield drops, mortgage rates have room to improve. As these lines over here go up, these are mortgage-backed securities. Mortgage rates have room to improve. That's why we've seen such a tremendous drop in rates recently. And then as that fear ebbs and flows, as everyone is afraid that the banking is in trouble, that the Fed's going to have to not do anything, maybe even lower rates. Well, as that sentiment takes over, then mortgage rates improve. But then what happens is people go, well, maybe we're wrong. Okay, the banking thing looks like it's okay. Maybe the Fed has that under control. Maybe they're going to have to raise rates because that inflation data came out and it's showing inflation's not going down enough. And well, if they do that, then, well, maybe they will raise rates. And when we see that happen, mortgage rates start to creep up a little bit. So we're seeing, right now you're going to get seasick. It's like being on a boat and you're like, whoa, and that's just where we're at right now. And that's what y'all are going to see if you're talking to your mortgage professional, if you're watching, the headlines, like you're going to see headlines like this. They're not going to be very accurate because they're delayed. But we see mortgage rates retreat for the first time in 5 weeks. And that, that was because of what happened. And then we're going to see them go up again and down again. I mean, just in the last couple of days, Thomas, have you seen rates change, dramatically on anything you've quoted over the last couple of days?
So I've been very careful because not every lender is pricing based on the market movement, penny for penny, right? So you're seeing big differences, 0.5% in some cases. Between lender to lender. So we're being very careful with taking our time with our quotes to make sure that we're putting everyone in the best possible position.
Yeah, and as a consumer, you want to factor that in, and that's one of the things. Actually, if I pull that up on our little on our thing here, is people say, okay, well, where do mortgage rates come from? And I'll go to the forecast in a minute, but why mortgage rates change? Mortgage rates are based on the bond market, on these charts here that we're looking at, and how these bonds perform, and all the fancy, the fancy little images that we've got here. But they also, why they're different from lender to lender, is that rates vary among lenders based on their margin. The lenders have to work with these rates on the back end, and how many loans they're doing, and how much money it takes to run the companies. So rates vary among lenders based on their margin and how much extra the lender has to charge to make a profit. And that can be affected, like it says on the slide, by overhead, staff, loan expenses, company profits, commissions, all those things. So, and you also have different philosophies right now. When we see a lot of volatility in the markets, we see these very large candlesticks. If I kind of zoom in on this for y'all, you can see that normally, this one kind of makes it look a little less, but see small ones here, those are kind of more normal. And then we have these very large, you see how quickly this has moved up. All of February, this moved down. And that's when mortgage rates got worse, when you see these go down through that month of February. And then almost over the last few days, we've recovered almost 2/3 of that already that we're up to. And when we see this big of a movement, lenders have different philosophies on how they're able to price and what they have to do with that. So that's why you'll see that big swing amongst everybody on all that too. But I mean, kind of even with that in mind, do you think that someone should be afraid to be out there looking for a house right now, Thomas?
You don't. That right house will just pop up when the time is right. You can't time it on the market for sure.
Yeah, I think so too. And what do you think will happen? I've seen a couple of people that talk about that this may cause, housing prices to drop. Do you think that that's going to happen?
I don't. There's still, in my area, in my market, there's not enough inventory. So until that changes, I don't think that'll ever happen. Can you hear me?
Oh, hello. I lost you for a minute. I don't know if it was on your end or mine. Please repeat that last part just in case it was yours.
Oh, looks like it cut out again.
Oh, is it me cutting out?
No, I don't know.
It might be me. I have Starlink, so.
In my market, we're still losing. So we live in an area where there's attorneys, and we have 6 days that we have to wait before we're actually under contract after an offer is accepted. So I'm still seeing, multiple times per week, offers going in, accepted, and then lost during attorney review. So I don't think that's the case in my market until there's more inventory. That's just not going to happen.
Yeah, now, I agree.
There's some other areas where I'm doing business in Pennsylvania where it's maybe a little more likely that it could happen in rural kind of areas. But I think overall, I think the market's still very, very strong. So I don't see that housing is just going to drop.
And this is unlikely to make any change to that either. And so what's happening and kind of someone replied, you guys are right. It's crazy how a lender that was pricing the best last week is now almost the worst pricing this week. And that's why we've talked about how important it is to shop around. If you are under contract, if you're working with a mortgage professional, reach out to them, talk to them, give them a chance to, renegotiate your lock, or to walk you through that. You don't necessarily want to look at changing who you're using with for your mortgage. It's a bad time to do that if you're under contract. But make sure you are communicating. And most of the time, somebody like Thomas, a loan originator, a loan officer, they're going to reach out to you and say, hey, there's been a big move. These are our options, or this is how that affects you. So if you're currently under contract and you have something, again, make sure you are talking to them. You don't necessarily need to worry about moving your loan or working with a different mortgage. You don't necessarily need to go crazy shopping around again. Just talk to them and let them work with it. Thomas, anything you would add about that part?
That's very well said. I agree 100%. I think it's really important to kind of stick by your advisor and just sort of trust them. They're the ones that are in the weeds, 24/7 here. And all of these headlines, like you said, are delayed. By the time you see them, the market has done 20 different things. So just lean on your advisor and really trust in them. And make sure if you haven't picked your advisor yet, you vet them and you make sure that they're the right person for you, that you will trust, so that when times do get a little rocky, you already trust the person that you're with.
Absolutely. Great advice all around. So let's go back. Let's talk about rates and let's give you guys a little bit of a forecast. So what do I think is going to happen from here? Rates are likely to be volatile. We're going to see, meaning that they're going to bounce around. Today they could be, just for a round number, they could be at 6.5, and tomorrow they could be at 6.75. And then the day after they could be at 6.5 again. When we see the kind of volatility in the markets that we're seeing, that's what happens. And it's all going to depend on how markets are pricing in what they think the Fed is going to do. So right now, because it's almost a 60% belief that the Fed is not going to raise rates in March, that's why we've seen such a tremendous improvement in mortgage rates. If this changes, like I have seen over the last couple of days, very much so, this will drop down to maybe 10% or 20%. And then we see an overwhelming belief the Fed is going to raise rates by a quarter point. Mortgage rates will react to that belief, and they're going to get a little bit worse. So it really depends on what we're seeing here, what the headlines look like, and events that convince the market that the Fed is done raising rates, they're going to help your mortgage rates improve. And those kinds of events are, like today we had what's called the producer price index. This is wholesale inflation. And this came in a little bit better than what we were expecting. And, prices unexpectedly fell. And I was very excited about this, Thomas. The reason I was excited about this was because the decline in wholesale inflation, believe it or not, 80% of the retreat in the merchandise part of that was because of the cost of eggs dropping. That's how expensive eggs have been. So because the cost of eggs have improved, it actually has helped inflation. As far as consumer inflation, we got this report a couple of days ago. Now, this was actually just yesterday, rather. And last week, I said, hey, this CPI inflation report, this is a really big deal. It's probably the biggest deal going on. And yet, once we saw this banking stuff on Friday and again on Monday, it really got crazy. The CPI became an afterthought. It got placed on the back burner. Now, we did find that, that the CPI came in a little bit hotter than expected. We're still seeing disinflation, but not as fast as everybody wants to see it. And, that's kind of the bottom line here. But this did not have a huge effect on mortgage rates yesterday because of that overall big picture due to the banking scenario that everyone is thinking the Fed cannot be as aggressive raising rates as we were expecting to see. Some of the other stuff that's going on here, retail sales came in this morning. So consumer spending is what drives our economy. In order to see mortgage rates improve, unfortunately, that generally happens when we see a recession and when we see the market slow down. So by consumer spending slowing down, that's a sign that the Fed may not have to be as aggressive. So these are all different variables that are coming into play right now. And then next week, we have the Fed's meeting. And where am I? Get the right slide. There you go. Next week, we have the Fed meeting. And that Fed meeting, it's a 2-day meeting. It starts on Tuesday. It ends on Wednesday. And on Wednesday, they're going to come out and they're going to have a few different things that are going to matter to us. Number one, they're going to come out with their actual rate. So right now, a lot of people are thinking the Fed may not raise rates next week. So they may not raise rates, and that'll be a big deal. Or they may raise rates 0.25%. And if they do that, that will be a big deal. Or they may raise them more than that. They could raise them 0.5%. And if they do that, it would be a really big deal. Go ahead, Thomas.
Is there a chance they would ever reduce them by a quarter?
It's not expected at this meeting. The first thing that, it's kind of like slowing down a locomotive. We've really, over the last year, we've built up speed with this locomotive, and they can't just stop it, but they can start to put the brakes on. All the sparks would fly. And that's why there's some expectation that they could raise rates this month and then actually lower rates in May at the next meeting. And, so all of these things, it's like tracking a hurricane and where it's going to landfall. We've got great technology today with the software, computers and satellites, and we track these hurricanes. And yet little variables, they joke around and say, where a butterfly in Mexico flaps its wings could affect where this hurricane, 1,000 miles lands. And that's the same thing with mortgage rates and with rates in general right now, is all these little things are coming into play. And the opinions out there, they're crazy. There's opinions of everything. Some people will tell you that the Fed's going to have to drop rates next month. Some people tell you the Fed still has to raise rates next month. So there's the opinions vary widely, and we just want to be ready to react to that. So that Fed meeting next week is a big deal. Y'all are going to want to be prepared for that. We're going to talk about that next Wednesday. We'll go into more detail because that's going to happen at 2 p.m. Eastern time, and we do these at 12 o'clock Eastern time. So next week, I'll talk more about the Fed meeting, what we're expecting, but the other events that are going to happen right after that Fed meeting, they're going to raise rates. They're going to release a policy statement. They're going to release their forecast on where different Fed members anonymously forecast where the Fed rate is going to be. They do that once every quarter. So we're going to see that at this meeting. The last time we saw that was in December. So there's a big expectation of, this may be dramatically different than what we saw. And if it's not, markets are going to, maybe they don't agree with what the Fed members think. So there's a lot that's going to happen over the next week. A lot of options for mortgage rates to bounce around. But generally, we should stay within this vicinity, kind of where we're at. I'm going to bring you guys up on the next slide and throw these back up on the screen for you. So in the next 15 days, I have my little guy shrugging like this because it's crazy. I even can't give you a forecast on what it could be because it's so reactive to whatever data we're getting and how markets are feeling that day. We are totally at the whim of the markets and traders and how they feel that things are going. So my forecast is to have my hands up like this because I don't know. Over the next couple of months, we're looking at rates probably improving based on the current outlook. Now, this could change. Again, next week, we get different data. We get different things to make an opinion on. And then all of a sudden I say, hey, the next few months rates are going to go up. It really is volatile right now, and it could go either way. This should not stop you from being out there looking at homes, though, or buying things for sure. It's not something that should slow you down. And then lastly, rates are going to improve again, significantly when we see signs of a true recession, when the economy is slowing down, labor market's weakening, and we see falling inflation. So that's kind of the forecast. Thomas, what about you? Is there anything any advice you'd give anybody out house hunting or thinking about buying a house today about any of this?
I'm not sure about the advice, but maybe a question for you.
Okay.
So when rates fall or expected to fall, how long do you think that would last? If we are officially in a recession and now rates are starting to fall, how long do you think that time would be?
Once we really see that happen, it's going to last all of through 2023 into 2024. So right now, we, just last month in February, I used the line, what once seemed unthinkable is now unavoidable. And we had general rates that were pushing up into the sevens. Now, VA rates tend to be a little bit better than conventional market rates, and they were in the mid to high sixes. But we had conventional rates that were in the sevens, and that seemed unthinkable. We thought that was behind us October of last year. And then rates pushed up. Now they'll push back down. If we get that recession, if we see things slowing down, that's going to push VA rates down into the fives and conventional rates into the high fives, low sixes. And that's where they'll gravitate and stay for a while. And they'll still move up and down, but they'll be within that range. Again, for VA rates, you'll see them in that kind of mid to high fives. And then for conventional rates in the high fives, maybe low sixes. So that's the expectation for when we do see that. If we're going to have a clear idea of where rates will go next week after next week's Fed meeting. And that's going to give us an idea of kind of where we go from there.
So I suppose my advice might be to anyone who's buying or just purchased, be patient. Don't jump on the headlines and say, oh, let me go refinance my rate right now, because long term, most likely they're going to go down a little further. So give it some time and lean on your advisor.
Right. And also
trust them.
And along those same lines, you don't want to try to time the market and get the quote unquote best rate, because rates will probably improve over time. You will have an opportunity to refinance, to possibly use the EARL with your VA benefit, which is the interest rate rapid refinance loan. These are options that you will have. The worst thing you can do is try to wait until you get that sweet spot for rates so that you can get things. Because I'll tell you what, when rates go down, Thomas, what do you think happens to house prices?
They go up.
Yeah, they go up. So when rates come down, so by waiting for rates to come down, that's going to increase competition. People are going to jump off the fence and get back into the market. We're going to see more bidding wars. We're going to see higher, home prices. So everything has a plus and a minus. Right now, you can jump on a home, get an interest rate that you can afford, and possibly improve that in the future. If you wait until rates try to come down, trying to time that, you're going to find even less inventory, more competition. That's a bad look. So,
Yeah,
All
there's
right.
always a temporary buy down option to talk about as well.
Exactly. Yeah. And that's a great option. And if you'd like to talk about things like a temporary buy down, definitely reach out to one of the vetted VA professionals. You can ask about that in the Facebook group, and people will be glad to explain that. Remember, vetted VA, the Facebook group, is a safe space where you will not be solicited. You will just be informed and educated. It is a great place to come and learn more about it. Thomas, anything that you would add for everybody before we wrap it up for this week?
No, I appreciate you, man. Your education, your leadership.
Thank you very much. Remember, everybody, join us next week. We do this each and every week for you. There's green here. Oh, my computer acting up again. There we go. So we do this each and every week for you, 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. I will see y'all next week. Take care, everybody.